If you're new to trading options, or maybe you have been trading for a while but you have not been consistently profitable, then listen up, because in this video, I'm going to be sharing with you that all you need to be consistently profitable is just one option strategy and maybe even just one underlying. Now you might be asking, okay, David, so what is this one strategy that you're talking about? Well, it's none other than the bull put spread. So the bull put spread is a very simple strategy, also known as the put credit spread. So let me just show you how it works down here. So imagine this is the price movement. All you got to do to create this bull put spread is to sell one put option that is out of the money, and then you buy another put option that is further out of the money. In this way, what you have down here is the bull put spread. So why do I suggest the bull put spread, especially if you're new to trading options? Well, firstly, it's actually a very simple strategy. As you can see down here, all it takes is just 2 legs. And secondly, you have your max loss cap because of this long put down here. That means to say, even if the market goes all the way down, even way past your long put, you cannot lose more than what you've risked on this trade. So let's say, for example, if you decided to only risk, let's say $500 on this trade, then no matter how far below the market goes, you will only lose $500 as the max. So this is a very good way to cap your loss. Now, at this point, you might be saying, but Davis, I've already been trading the bull put spread for quite some time, but I haven't been profitable. Well, if you have not been profitable so far when you're trading the bull put spread, it could be one of 2 things. Number one, it could be that you have the wrong mechanics on. So for example, maybe you've got the wrong delta, or maybe you've set it up the wrong way. Maybe you have got the spread width a little bit too tight, or maybe you're managing it the wrong way. Or number 2, it could just very simply be the wrong choice of underlying. Because not all underlying is suitable to trade the bull put spread. For example, some underlying is more suitable for you to trade the bearish strategies, while some other underlying could be better for the neutral strategy. So it's very important to choose the right underlying to match the strategy. So in terms of the bull put spread, you might be asking, okay, David, so what should I be trading as the underlying for the bull put spread? So if you're new to trading options, or so far you haven't been getting the results that you want, then I would strongly consider trading SPY. Right? In fact, SPY is one of my favorite underlying to trade the bull put spread. And as you can see over here, I've got quite a number of the bull put spread that I've been trading on SPY. Now, at this point, whenever I talk about trading, the bull put spread on SPY, inevitably, I will have some people that go, but Davis, SPY, the volatility is so low. I cannot get much premium on SPY. How am I supposed to make some money? Why can't I go for the higher volatility underlying? Like, for example, Tesla, or maybe GME, give me the 100% volatility. Well, if you have been struggling to be profitable so far, then maybe that could be the reason why. So let us do a little deeper dive into this. Right, so let me go over to the chart, and as you can see over here, this is SPY. So what's the first thing that strikes out to you when you take a look at this chart down here? Well, you can see that over the long term, SPY is going up, right? So this is what you call positive drift vehicle. It just wants to go up over the long term. So if you pair a positive drift underlying like SPY, and you pair it with the bull put spread strategy, which is a bullish strategy, a neutral to bullish strategy, it's not going to be that difficult for you to make money on SPY, right? It's going to be harder if you try to make money on the way down. For example, if you try to trade the bear call spread and capture all these very small moves down here, it's going to be a little bit tougher compared to if you were to capture the moves on the way up, right? As you can see, the moves on the way up are usually longer and more often than the moves down. So that is why the bull put spread strategy actually makes sense on SPY. Now, what about Tesla? Well, that's a very good question. Let us take a look at Tesla. So let me just remove the drawings here and let us take a look at Tesla. So Tesla, as you can see, yes, it has actually shot up quite a bit ever since, the price before 2020, right? The market has really shot up, and all those people that have actually bought the shares itself would have made quite a bit of money. But what about the bull put spread? Does it mean that the bull put spread, you're going to be profitable as well? Well, if you take a look at how the market has been moving, or rather how Tesla has been moving over the past 5 years, you can see that it pretty much has been going sideways. Now, although Tesla has been progressively moving up, as you can see over here, there are some up moves like here, here, and here as well. The thing is that it's not going to be as easy as compared to trading SPY, because if you were to take a look again at SPY, you can see that most of the time, at least during this same period of time, there's more up moves than the down moves or the sideways movements. But if you take a look at Tesla, Tesla is pretty much moving back and forth. So while you get much more premiums with Tesla, you actually can lose more on this trade as well. Why is that so? Because remember, when you're trading the bull put spread, one thing is that your credit, that means to say the upside, is actually limited. You're limited to the amount of premium that you receive in the first place. So even though if you have such explosive moves to the upside, you're not actually able to capitalize well on this with a bull put spread. Again, because you only make the premiums that you receive from the bull put spread. Whereas on the downside, you can actually capture more of the downside losses. So the way the bull put spread is designed is that when you make money, you actually make lesser than when you lose money. So if you see the moves are pretty big on the way down, then this is the place whereby you could probably lose more than compared to what you make, and your win rate not as high as well. So that's one of the problems with all these individual stocks. Yes, you get more premiums, but you get much more volatility as well, and also you have to deal with unexpected news and earnings. So during such times, it could actually make the underlying have a very big move, either up or down. Now, what about those people who love GME, right? The high volatility kind of option sellers. Well, if you take a look at this over here, GME is pretty much, I wouldn't even say it's a chart. It looks more like a heartbeat rate monitor, right? You can see every time you trade GME, you get heart attack, and then, oh, GME is doing well, not so heart attack, and then you get heart attack again. For the most part, GME is pretty much going sideways. And if you want to try and find the moves all the way up, as you can see, it's also explosive moves. But the moves like this are far and few in between. Most of the time, the market is going sideways or going down. That is why it's going to be a little bit difficult for you to trade the bull put spread strategy on GME. So now the question is, okay, you said SPY to trade, but SPY over the past 5 years, there has been, the pandemic crash, and also there is the bear market. How would the bull put spread perform during those times? So that is a very good question. Let us take a look. So right now I'm using the backtesting tool function of tastytrade, and you can have access to this as well if you have a tastytrade account. It's free to use. All you got to do is click this icon down here that says backtesting, and you'll be able to see this same as what I have down here. So for this, let us go back to the past 5 years, starting from the pandemic, right? Before the pandemic, in fact, right? The 1st of January 2020, and all the way to the end of 2024. So you have a 5 years period for this. So let us first take a look at Tesla, right? How did Tesla perform over the long term if you had continuously put it on? So as you can see over here, what I've done is that I've just used the default option. So as you can see over here, all you got to do is just select this credit put spread and just leave everything the same. Now for this condition, I use it as every day, but I will limit the number of active trades to just one. So what it does is that you're just putting on one trade. Once you close that trade, you put on that same trade again. So due to the limitations of such a backtesting platform on tastytrade, whereby you cannot time the market, you can only just put it on every time. Well, once you have a trade on, once you close it, you put it on again. So let us see how it does. So what I've also done down here is to exit at 21 DTE. So this is one of the trade parameters or a mechanic that the tastytrade team have very thoroughly tested, that it shows that you actually do have better performance over the long term than if you hold to expiration. At the same time, you also reduce the chance of early assignment, because if you're trading this on individual stocks or the index ETF, if you're going to be in the money and it's going to get close to expiration, then you have the risk of early assignment where you can get the shares, right? So this is something that we want to try and minimize the chances of. So we're going to put this as exit as specific DTE, which is 21 DTE. Everything else, I'll just leave it as default. So let us run the backtest and let us take a look. So what do you guys think? Is Tesla going to be profitable over the past 5 years, or is it going to lose money? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So as you can see over here, over the past 5 years, Tesla has not been profitable when you're trading the bull put spread. Well, like I mentioned, if you take a look at the chart again, all right, let me just very quickly go back to the chart, remove this drawing over here. You will see that The reason why it has not been profitable, mainly also because there's quite a lot of these big moves down. So like I mentioned, in a bull put spread, if the market was to go down or when you have a loss, usually the loss is bigger than your wins. And if your wins in terms of the percentage is not going to be big enough to compensate for the losses, it's going to be overall in a loss. And that's exactly what has happened over here, right? You can see over here, your total loss will be down 3,000, you're down 4%, which is actually not a lot. But if you were to take a look down here, if you were to do a buy and hold, you'll be up 1,331%. So Tesla, not exactly the best underlying for you to trade the bull put spread. Now, you could be saying, but Davis, I'm very selective, right? I take a look at the chart, I use technical analysis. Yes, you can. And if you are able to be profitable by doing that, then good on you. Definitely no problems doing that. But I would prefer to choose an underlying whereby even through all the ups and downtime, if I continue to put it on and it's still going to be profitable, then I know that if I'm going to be selective on it, it will give me a greater edge. So now let us take a look at the next one. Let's take a look at GME. So same thing, let me just go over to the new back test and then I'm going to bring GME over here. I'm going to keep all the parameters the same as well, and then let's run the back test. Okay, so as you can see over here, this is the results for the bull put spread over the past 5 years. And the interesting thing is that it was actually a profit over the past 5 years. As you can see down here, it made about 12.7% over the past 5 years. But if I knew I was going to 12.7% for 5 years, putting all that money at risk, then I would rather just put it in the T-bills, right? But here's the thing, if you put it into stock, the buy and hold down here, you would actually get 1,903%. So like I mentioned, not all underlying are suitable to put on the bull put spread, and GME is one of those examples. If you want to trade the bull put spread, you want to get some consistent profit, you can see that GME is not the right vehicle. Although you get a very high volatility, you get high premiums, but you're not able to keep most of the premiums, your returns are not going to be as good as compared to if you buy and hold, then what's the point of doing it on GME? So what about SPY? So let us do the same for SPY. Let me just remove all these drawings and let me look for SPY. So same thing, I'm going to keep everything else the same, and we're going to do it across the past 5 years from just before the pandemic and then into the pandemic crash and also into the bear market. And let us see how SPY has performed. Okay, so as you can see, this is the result of the bull put spread over the past 5 years, even across the pandemic crash and also the bear market in 2022. And the end result after the 5 years, as you can see, it's up 100.56%. So roughly an average about 20% per year over the past 5 years. If you were to compare this to buy and hold, you can see that it's about 82.21%. So you actually do slightly better than doing the buy and hold. In fact, if you have an 18% difference in terms of the return, that's going to actually make quite a big difference over the long term. So although you get a return that is higher than the buy and hold, one thing you need to understand as well is that your drawdown is actually higher than if you were to buy and hold as well. As you can see, buy and hold is about 34.1%. That's the drawdown. But when you do the bull put spread, because it is a leverage tool, right? Options are leverage, you actually have a higher drawdown. So in this case, you have negative 66% drawdown. So that is why doing the proper money management is also very important. So as you can see over here, this is if you have a small account, right? Down here, it shows your use capital is about $3,356. So if you have a small account, you can definitely use this strategy as well. So as you can see, over the past 5 years, the bull put spread has done well on SPY. Now, with that said, I want to dive in a little bit deeper into the two scariest time over this past 5 years when you're trading the bull put spread. Because in a bull market, of course, you're going to be having a smoother ride, right? A smoother journey you'll be making most of the time. But what about the two scariest period, which is during the pandemic crash as well as the bear market in 2022? So although in the long term, it actually is profitable, I want you to also understand what can happen and what the results are going to be during those two scariest times. So let me just adjust the time period over here. So the first one I want to take a look at is during the pandemic crash. So in 2020, let us take a look how the performance is for the bull put spread. So as you know, during the earlier parts of 2020, right, the first few months, there was a very big crash down. And then after that, the market eventually recovers. So during this big crash down, we want to know how did the bull put spread actually perform, so you have an idea in terms of how you can position your risk management as well. So let me just run the back test here and let us take a look at the results. So as you can see over here, in 2020, the bull put spread was actually profitable. In fact, you can see over here, the return is 24.32% despite the pandemic crash, and the buy and hold is only 13.52%. So the bull put spread strategy is profitable also because the underlying that you're trading it on is profitable. Now, although the bull put spread was profitable in 2020, a more important number that I like to look at is this one down here. You can see that the max drawdown is actually negative 66%. If you were to do a buy and hold, it's only about 34%. So almost double the drawdown. And this is very important to really take note of, because when you're trading the bull put spread, you need to have proper money management. If you trade way too big, then of course this is where you can get into trouble. So if you recall, when we did the 5 years results for the bull put spread, the max drawdown was also roughly around negative 60 something percent. So most likely it's because of this pandemic crash which happened around here. So if there was no pandemic crash during the past 5 years, this bull put spread, the max drawdown would slightly be better. So in 2020, it was a profit. Now, what about in 2022? So 2022, we know that SPY actually went down, right? It was a bear market. So this is where we want to take a look at the performance during the bear market, so we kind of know what to expect as well, because you cannot expect to trade one strategy and then be profitable every single year. There will definitely be some losing months, sometimes very rare as well, losing years as well. But again, the most important thing is that over the long term, you're going to be net profitable. So this is where sticking to the strategy is very important, and also having proper risk management. So I'm going to put the start date as the beginning of 2022, end date as 2022. Everything else keep the same, and we're going to run the backtest and let us take a look at the results. So as you can see over here, we are actually in a loss, and the loss is actually much bigger than what SPY actually had for us. So as you can see over here, your return is minus 48.44%, whereas buy and hold, you're only down about minus 18%. And let's take a look at the drawdown as well. So the drawdown, again, also about 60%, and buy and hold is minus 25%. So this is something you need to understand about trading options. Options is a leverage tool where we try and get a higher return because it's more leverage, but at the same time we can also have a higher drawdown. But as long as you know how to manage your capital well, you do proper risk management whereby you do not let your entire account blow up, then you definitely still have funds to eventually fight back. Because again, as you can see, let me just go back to the results for the entire 5 years. So if we were to go to the results of the past 5 years again, let me just adjust this to 2024, and we will see the whole thing. You can see that the bull put spread strategy traded across all the 5 years, and it was continuously put on even through the pandemic crash, even through the 2022 bear market, and eventually it ended up positive. Now, after seeing these results for the past 5 years, you might be saying, but Davis, is it possible that I be selective with my entries? That means I do not continuously put it on all the time, but rather I time my entries, right? Maybe I use technical analysis, or maybe use some indicators like the stochastic indicator to time my entries. Can I do that instead? And the answer is yes, you can time it to identify places where you think the market is going up before you enter into the bull put spread. In fact, this is something that I do share in a number of my videos, so you can actually go and check it out, where I talk about using the stochastic oscillator. So as you can see over here, this is the stochastic oscillator, and it tells you when the market is either overbought or oversold. So generally, when I use the stochastic indicator, I do it on a daily time frame. So this is something that I get asked quite a bit. You know, what's the time frame where you take a look at the stochastic oscillator? Well, it is on the daily time frame. So if you're using the stochastic oscillator as well, then you want to wait until the oscillator is showing an oversold reading before you consider putting on the bull put spread. So this way, at least you get a much better entry point, rather than if you were to enter when it's overbought. Usually these are the times whereby the market could either pull back a little bit or maybe even have some reversal. But again, like I mentioned, over the long term, you're still going to be profitable, because if you use a bull put spread strategy, a bullish strategy on a positive drift vehicle like SPY, again, the edge is on your side. All right, so this is the bull put spread strategy on SPY. As you can see, over the long term, it will be net profitable. And if you're new to trading options, I would strongly encourage you to at least consider trying it out. Hopefully this video has been helpful for you, and if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe for more videos like this, and I will see you in the next video.